what the silver market might do if the gold market tripled or quadrupled. I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. I'm a credit guy, really. The market share.
Welcome to a crucial conversation that's both timely and of utmost importance. Today, we have the privilege of joining the legendary Rick Rule. He will examine the ramifications of surging yields, the potential reverberations in the market, and the promising outlook for gold and silver investors. Get ready for a compelling exploration of the financial landscape.
I'm nervous about allowing the present or the immediate past, to allay some concerns about the future. This is why I, like you, remember the decade of the 70s. And I remember the debt that had been accumulated by the United States in the sort of guns and butter era. And I remember that the first half of the decade of the 70s, despite the fears, wasn't too bad. I remember, too, that the interest rates rose. And I remember the discussion in the Wall Street Journal saying, this is an economy that can take a punch. The interest rate doubles and the economy stumbles on. Well, it stumbled on till 1976. And I'm concerned, and I think that your listeners should be concerned rather than terrified about the delayed reaction that could happen in the economy as a consequence of higher interest rates. I'm concerned, too, about the impact of that debt, and I'm particularly concerned, Mike, about the lack of concern around the debt. This is truly perplexing to me. I suspect that because we've gone through 40 years of pretty good economic climate, that people expect the future to be as benign as the past was. And I'm afraid it won't be. Just for fun, Mike, if I might continue, let me cite some interesting statistics. The U.S. federal debt on balance sheet exceeds $33 trillion. Now, it's true, net of the Fed's own balance sheet, that the net debt is, quote, only $26 trillion. Note that that's before state and local debt and before unfunded private pension liabilities. But the thing that really, truly scares me is the off-balance sheet liabilities of the U.S. government, the entitlements, Medicare, Medicaid, Social Security. The Fed considers a bank with a 7% equity slice to be well capitalized. I'm an old guy now. I've been in banking 40-something years, and I know that sort of 1 or 2 years out of 10, as a banker, you're confronted with some truly ugly surprises. That's the way it works. So the arithmetic that makes sense to me is that 10% is a much better number than 7%. Banks are supposed to have some money in them, equity in them. And we seem to have forgotten about that in the United States. And then there's this problem called duration risk. One of the ways that the unwise in banking make money is that they borrow in the near term and they lend in the long term, and they try and arbitrage those two. The difficulty with that is that if you borrow in the near term on a fixed rate and you lend, at a floating rate, and you lend in the long term at a fixed rate, an increase in interest rates wipes out your business. Some of you will remember the savings and loan business. That's what went wrong. There wasn't a catastrophic decline in real estate prices. There were people that experienced funding difficulties where they had long-term assets and no access to funds in the long term. And that's what happened to Silicon Valley Bank. It's what happened to First Republic Bank. It's what happened to Bank of America's earnings last quarter. In truth, people need to pay attention to their banks. They need to obtain something called the Statement of Financial Condition, which the bank must give you. And the accounting is very, very, very tricky. The regulators allow banks to hold long-term bonds on their balance sheet if they say that they're holding them to maturity with no mark to market, which is to say if a bank holds a 30-year bond that was bought in a period where a 30-year bond would yield 2, And now the 30-year bond yields 4.5%, so the capitalized value of the bond has fallen by half. The bank is allowed to carry that bond on their balance sheet at par. Gold does well during periods of time when people's concern about the maintenance of their savings in US dollars are challenged. In other words, gold does well in bad times. I'm 70. I just as soon not see any bad time. Will gold break through 2000? I don't care. I don't own it because it would go from $1,925,000 to $2,050. I own it because of the lessons that we learned in 2000, where it went from $253 over 10 years to $1,900. I own gold because I'm afraid, not hopeful, I'm afraid it'll go to $6,000 or $7,000. When the narrative is driven by gold, which is to say when the precious metals market momentum is driven by gold, silver, for whatever reason, perhaps it's lower unit cost, travels further and it travels faster. In my experience, gold has to establish the pattern, but then silver outperforms it. And honestly, I have no earthly idea what the silver market might do if the gold market tripled or quadrupled.
Right.
I have real fears, not hopes, fears that the gold market will triple. Let me give you, I always revert to math. You know, I'm a credit guy, really.
Yeah.
The market share of precious metals and precious metals related investments, securities, stuff like that, gold stocks, comprise less than one half of 1% of total savings and investment assets in the United States. As Robert Friedland would say, a pimple on an elephant's behind. The 2-decade mean market share of precious metals among U.S. savings and investment assets is 2%. So if concern about quantitative easing, debt and deficits, negative real interest rates became a little more broadly spread in the U.S. economy, and if the market share of precious metals returned to mean, I'm not talking about crushing the bond market, I'm talking about returning to mean, demand for precious metals and precious metals related assets in the United States would quadruple. And that's precisely what I think is going to happen. But you know, we don't need that inflammatory number to make our case, Mike. All we need is reversion to mean. Reversion to mean quadruples demand in a market that's 22% of the world's savings and investment assets.
Rick's deep dive into the consequences of surging yields, the potential market reverberations, and the promising horizon for gold and silver investors is a treasure trove of knowledge. If you found this video as illuminating as we have, please consider supporting our channel by liking and subscribing for more pivotal financial discussions. Your engagement is the backbone of our commitment to providing you with invaluable content. Thank you for being a part of today's conversation, and we eagerly anticipate presenting you with more enlightening discussions in the future. Stay informed and stay at the forefront of financial insights. Until our next encounter.